Where is the market headed? Everybody wants to know that. Everybody needs to know that. They're dying. Paul, where's the market going? I get so many questions in our Everything Money community about this. So first off, it is November 8th at 2:27 p.m. Eastern time. I'm not talking about today, and this video is probably coming out many days after I recorded it. We're talking about the future. So if you're new to this channel, there's two things I want you to do. I want you to watch the whole video, hear my discussion, and also subscribe if you like it, because this channel has over 1,800 videos. It might be 1,900 videos now. We do a lot of talking, 2 or 3 videos a day. During earnings season, we do like 4 or 5 videos a day. We're on the ball. We get videos out quickly. So where is the market headed? Guys, I believe in looking at the long term. I believe that the stock market to GDP ratio is the most reliable valuation metric at any given time, just like Warren Buffett says. I also like looking at the 10-year cyclically adjusted PE ratio, but the stock market to GDP ratio is the highest correlation to future 10 and 12-year returns. So where does it stand now? Well, I created my own stock market to GDP ratio based on the S&P 500. And if you're part of our community, then you are going to be getting access to this in the future. It'll be displayed every single day, updated every single week for you. Here's where we are right now. Going back to 1929, currently we're at 1.479 stock market to GDP ratio, which is 59.2% overvalued. The historical average is 0.929, and we're at 1.479. We hit a high of 1.923 in the second or third quarter of last year. Now, here's the scary part for the future. Let's go to the peak of the 2000 bubble, before everything started to blow up. We're going back to the first quarter of 2000. The peak was 1.461. 1.461, and we're currently at 1.479 after the market is down 20% already this year. So, what does that tell me? We have a long way to go. Let's look at history. On average, going back to 1929, the rolling 10-year returns are 6.6%, not including dividends. When it's undervalued, the average is 9.3. When it's overvalued, it's 2.3%. So significant difference between under and overvalued. And we're currently 59% overvalued. The scary part is when we're 30% or more overvalued, the average is a negative 0.3% return. So if you're new to our channel, you haven't heard this before probably. If you've watched our channel before, you hear me talk about this ad nauseum, and there's a reason for that. I want everybody to ingrain in their heads that valuations are what matter in the long run. In the short run, it's all about what's hype, what's exciting, what everybody loves, what your neighbor's 18-year-old son loves. That's what's exciting. But what matters in the long run is which companies have the best fundamentals and are selling for the most reasonable price. And it makes sense. The more you pay for an investment, the less your return is going to be, right? Think about it. If I'm going to give you $1 per year for the rest of your life, that's set. What a company makes is not going to be affected by what the stock price is today, up or down. So the more you pay for that stream of cash flow, the less return you're going to make. The less you pay, the more return you're going to make. If this sounds confusing, don't worry. It was confusing for me too. I've been on a long journey, but over time I chipped away and I didn't have the benefit that you have, which is this brilliant man here to teach you about investing. Now, obviously, I'm not saying I'm brilliant. I'm just very, I believe, realistic. I sit here and I view the world from where I stand and say, what does it mean about the future based on what I say today? And the future, if I were to put all my money into the stock market today, says I'm probably not going to do the best for the next 10 or 12 years. However, what we teach on this channel is dollar cost averaging. What that means is the market's going to do this over time, but this is what the month-to-month, year-to-year returns are going to be. And your job is to buy all along the way in equal increments. Sometimes you will overpay, sometimes you'll underpay, but you'll buy and you'll end up averaging this, which will beat more than 92% of actively managed mutual funds over a 10-year period. All those Harvard MBAs and quote-unquote MBA geniuses, you're going to beat just by being a rational person. And that's what I'm trying to teach here. Mentality and emotion and process. But the mentality and emotion is the hardest part. If you have the right temperament for the stock market and you can be calm when everybody else is being crazy, you will do very, very well. Guys, the big justification for stocks being a lot higher or interest rates being low. Hey, I can get 0% in my bank, or I can buy the S&P and make 1.5% dividend. I'd rather have this. Now, what they didn't tell you was, this is all great and dandy until what? Until all of a sudden your major bank account goes down. And that's the problem with investing. People look too much at the short term. What I want you to remember is, as these rates have skyrocketed, if that was the justification for stocks being much higher was low rates, then what's going to happen when high rates come in, which we're currently in the process of doing? I believe Fed Chairman Powell has wanted to raise rates for a long time. He said it back in 2016 and 17, and then got bullied into not doing it. He's wanted to raise rates for a while. He needed his excuse, and that excuse came in the form of inflation. I've always said, if you look back at our 1,800 videos, and kudos to anybody who watches every single one of them, I'd be very impressed with you. If you go back and watch those videos, 2 years ago, a year and a half, a year ago, I kept saying one thing. I don't know what will cause the bubble to burst, but it'll be something. In 2000, we didn't have something, and it'll probably be something we didn't see at the time. And not many people saw inflation. Spoiler alert, go look at what I was saying when we were issuing checks last year. I was like, how are we not going to have inflation? Now, I'm not trying to sit there and say that I was some genius who figured it out. I just, again, sat there and said, okay, if we're issuing checks for everybody, enough so they don't have to go to work, then business owners like me need to pay more money to get regular employees. As they get more money in, what's going to happen? Well, guys, increasing wages isn't just wealth for everybody. It's increasing money out there, which increases costs. When it costs me more to manage my businesses, what happens to my products? They become more expensive. And I pass that on to the consumer. That's no different. That's called inflation. So the Fed is currently raising interest rates to fight that. And last week, Fed Chairman Powell said it'd be worse for us to under increase rates than to over increase rates. He's more concerned about not being aggressive enough. Now, does that mean he's going to do 0.75 every single time? No, but he has said we're not close to ending these interest rate bumps. Guys, a year and a half ago, 2 years ago, my fiance got a 2.65% 30-year fixed rate mortgage. As of yesterday, that same mortgage is 7.29%. That is 4.6% higher. That means her mortgage at $300,000 is going to be about $1,100 more per month than it would be if she got it today versus back then. That's a crazy number. That's a crazy, crazy number. That's a big difference when you're making $100,000, $120,000 a year. That's 10% or 12% of your before tax pay. So if your take home, we're talking about 15 to 20% of your take home pay. You know, I was at my future stepdaughter's house this weekend. She's having a baby. We were all sitting there. She has a beautiful home. Her husband was there. I said, hey, you guys are thinking about moving to the east side. And they said, you know what? Not going to happen. Because of these rate hikes, we're not going to be able to get the house we want to get on the east side. I said, oh, makes sense. So these are definitely affecting things. I just read an article today. Home builders are getting massive cancellations. So what does that have to do with the market? Well, guys, the 2-year treasury and the 10-year treasury have inverted. The 2-year treasury rate's like 4.25 or 4.3. The 10 years like 4.1. In the past, that has indicated recession. Now, if you were overly optimistic and you took the S&P to 4,800 based on, we don't see a recession coming, because go look at what it was a year and a half ago. We don't see a recession. It ain't going to happen. Everybody was saying that. All of a sudden, can you justify this anymore? Oh, we're not going to see more than a 10% drop. We got to what, 3,500 in the S&P? Guys, spoiler alert. Let me tell you what I think the S&P is worth. According to my historical sheet, the S&P's fair value today is 2385. Now relax. This doesn't mean that it has to go down there. I do think it'll go down to the low 2000s again, possibly lower, because of the fact that usually what happens is during expansion times, profit margins are much larger than they should be. And when they contract, they go much worse, and people will justify going much lower. Because remember, when you have the average, you don't go to the average and go back up. What you do is you go like this. So if we're here and fair value's here, yeah, along the way, we can end up, fair value could be there, but we'll probably go here instead. And that's the point. So what can happen though is this metric is based on GDP. And as GDP goes up and up and up, things can get better for the market. Look at it this way. In June of 2018, GDP was $20.5 trillion. Fast forward to March of 2021. So that's what, 3 years later, it had gone up $1.5 trillion. Since March of 2021, that's less than a year and a half, it's gone up $3.5 trillion. Why? Inflation. So inflation is your friend in that regard. It can really drive up GDP and make the stock market GDP ratio really drive up revenue a lot for companies. So there's not only downsides for inflation. In fact, guys, inflation is way better than deflation. Because in deflation, people stop spending because they'll say, you know what? Costs are going lower. I might as well wait. At least in inflation, hey, costs are going to go higher. I might as well. I'm doing a home renovation now. You better believe I'm trying to get rolling on this home renovation so I can lock in my costs. I was just on the phone with my flooring supplier saying, hey, our costs going up. He says, they're going up soon. I said, give me a reason today to buy it then. So that's as opposed to buying a less expensive floor because I still like it, but it's less expensive. So these are the things. If it was deflation market, I'd be telling my guy, hey, pal, I'm waiting until the very last second to order because it's going to go down in price. So where's the market going to go? My guess is over the next 3 to 5 years, we're going to see much, much lower levels. When, how, I have no idea. But in the long run, valuation matters. And I'm not going to fight 59% over valuation. But again, this doesn't mean go sell everything. In your retirement accounts, keep your low-cost ETFs based on the long run. If you have less than 10 years to retirement, meet with somebody and talk to somebody about how you should be invested because the next 10 years are not going to be pretty. You can still make money in the next 10 years, but it's going to be probably something like this is my guess. So if you dollar cost average along the way, you're probably going to pay an average of this. So you still make money overall. And that's the idea behind investing. You can never guess what's going to happen. All you can do is make decisions based on what you see and stick to a plan that works. If you have a portion of your money set aside for individual stocks, maybe it's a good idea to wait, but you should have the majority of your money in low-cost ETFs matching the market. Guys, I know you've liked this video, and I guarantee if you watch 4 or 5 of our other videos, you will walk away knowing a lot more about investing, because the more you learn, the less you fear. So please subscribe to the channel. I guarantee you will love it. Thank you very much for your time. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?